Nexnetia. Intelligence before the market moves. 5 companies are on pace to spend more than $1 trillion in 18 months. That is not a forecast. It is already contracted, already breaking ground, already wired into next year's capital budgets. Under normal circumstances, that number would read as conviction, proof that the smartest capital allocators on Earth see a future large enough to justify it. But in June 2026, the institution that exists to watch every central bank on the planet read the same number and used a different word. Fragility. That matters because the Bank for International Settlements does not warn casually. It is the coordinating body for the world's central banks, the institution that flagged the 2008 mortgage structure years before anyone in Washington would say the word crisis out loud. Its 2026 annual economic report named an AI spending bust and what it called circular financing as 2 of the 4 biggest threats to global financial stability. Alongside inflation and sovereign debt. Disappointment in returns, the report said, could turn the current capital expenditure boom into a prolonged investment collapse. You did not sign up to underwrite that outcome. But if your pension, your index fund, or your employer's balance sheet touches the 5 largest technology companies on Earth, you already have. That's the contradiction. Growth this large is supposed to mean prosperity. So why is the institution built to detect systemic risk pointing at the exact same growth and calling it a pressure point? Start with the number underneath the number. Economists tracking first half 2026 growth found that spending on information processing systems and software, the equipment and code that build and run data centers, accounted for the overwhelming majority of the increase in U.S. demand. Strip that category out, and the growth story most people believe they're living inside looks considerably thinner. That would be fine if the spending were funded the way normal capital expenditure gets funded, out of earnings. Increasingly, it isn't. Here is the mechanism the BIS is actually worried about, in plain terms. Chipmakers and cloud providers have started taking equity stakes in the very AI labs that then commit to buying their chips and their computing power. Money moves out as an investment. It moves back in as revenue. On a quarterly earnings call, that revenue looks like organic demand. It's the same dollar, doing a lap. The BIS itself put it directly, the terms of these deals are often poorly disclosed, and the same underlying asset can end up pledged more than once. Follow one real example. In 2026, Google committed up to $40 billion to Anthropic. Weeks later, Anthropic committed to spend $200 billion on Google's cloud and chips over 5 years, a figure that alone accounts for more than 40% of Google's entire cloud revenue. Backlog. Google's capital becomes Anthropic's purchasing power. Anthropic's purchasing power becomes Google's revenue. Both companies can now point to real, contracted, audited numbers. Neither number tells you whether an independent customer, with no financial tie to the seller, would have bought at that scale on their own. That is the first mechanism, revenue that is real on paper and circular in origin. And it doesn't stay buried in a press release. It surfaces in the one document a company can't spin, its own earnings report. Look at what happened when Alphabet reported its second quarter 2026 results. Operating income, the money the actual business generated from search, YouTube, and cloud, rose 30% to $40.8 billion. That's a real, earned number. But net income reached $112 billion, nearly triple the year before, and almost none of that gap came from selling anything. $98 billion of it landed in a line called Other Income, and Alphabet's own filing says the driver was a $99 billion unrealized gain on equity securities, the rising paper value of its stakes in companies including Anthropic and SpaceX. In the same quarter, Alphabet spent $44.9 billion on infrastructure and posted negative free cash flow for the first time in the company's history. Read those 2 numbers side by side. The headline profit came largely from marking up investments on paper. The cash actually leaving the building, for servers and data centers, exceeded the cash coming in. 3 weeks later, Amazon posted something structurally identical. Operating income, the real business, climbed to $27.5 billion. Net income came in at $62.6 billion. $53.4 billion of that, by Amazon's own admission, was a non-operating, non-cash gain tied primarily to its investment in Anthropic. Strip that one line out and the "earnings triple" headline mostly disappears. Meanwhile, Amazon's trailing free cash flow swung to a $7.6 billion outflow, driven by a $66 billion jump in AI infrastructure spending. 2 of the 5 companies at the center of this boom just told their own shareholders, in a legally binding filing, that a meaningful share of this year's record profit is the rising valuation of a private company they also happen to be selling cloud capacity to. That is the circular financing mechanism, showing up not in a conspiracy diagram, but in the income statement. If your fund owns the index, this isn't background noise. U.S. stocks now make up roughly 2/3 of the MSCI World Index. When 2 of the 5 largest companies driving that index are booking a meaningful share of this year's profit as an unrealized gain on the same AI lab they invoice every quarter, diversified starts to mean something narrower than most people assume. That's the first layer. There's a second layer underneath it, and it goes further than accounting optics. It goes into who actually holds the risk if the story doesn't hold up. In January 2026, Nvidia sold more than 100,000 of its most advanced GPUs, chips worth $5.4 billion, to a newly formed entity called Valor Compute Infrastructure. Valor has no independent operating business. Its only function is to hold those chips. Nvidia didn't just sell to Valor, it also invested $1.9 billion directly into Valor as an anchor partner. Apollo Global Management arranged $3.5 billion in debt to help fund the purchase. Then packaged that debt into securities and sold a large share of them to Athene, Apollo's own insurance subsidiary, the one that sells annuities to American retirees. The chips themselves ended up leased, under a triple net structure, to a subsidiary of Elon Musk's xAI, powering its Grok training cluster. Walk the chain slowly, because each step changes who is exposed. Nvidia books $5.4 billion as completed sales revenue. xAI gets full use of 100,000 top-tier chips without adding that debt to its own balance sheet. Valor, the shell in the middle, holds the physical asset and the physical risk. And the financing behind Valor runs, in part, through an insurer whose reserves back the retirement income of people who have never heard the word GB200 in their lives. Investor Michael Burry, who built his reputation calling the 2008 mortgage structure before it broke, published a diagram of this exact chain and called it Fugazi, his word for something engineered to look real. Burry is not alleging anything illegal. Every part of this structure is disclosed, in filings, by companies that confirm the transaction happened as described. What he's flagging is narrower, and in some ways more uncomfortable. Roughly a third of the insurer's relevant asset pool sits in holdings with no observable public market price, carried at meaningful leverage, and shifted partly into a Bermuda-based affiliate outside standard U.S. oversight. None of that means the annuity fails. It means the people holding it can't easily see what it's actually backed by. So ask the question the BIS structure forces onto the table. If the GPUs inside that lease become technically obsolete, and GPU generations turn over fast, who owns the asset supposedly worth $5.4 billion? Not Nvidia. Not xAI. A shell company, financed in part by retirement premiums, holding hardware with a shelf life measured in a couple of product cycles. That's the second mechanism, leverage engineered to sit somewhere nobody is watching closely, 3 or 4 steps removed from the name on your quarterly statement. At this point the spending looked aggressive, the accounting looked flattered, and the financing looked complicated. None of that answers the harder question: can the machine underneath all of this actually generate a return large enough to justify what's already been committed against it? Nexnetia Strategic Intelligence. The same window in which the BIS published its warning, a different story showed how far the paper economics of this boom can stretch. In June 2026, SpaceX completed its public listing, one of the largest in history, and its market value climbed past $2.5 trillion within days. 4 days after that debut, SpaceX agreed to acquire the AI coding company Cursor for $60 billion, entirely in stock. Because SpaceX's share price had already risen sharply since the IPO, the acquisition effectively cost the company nothing in cash. The stock's own appreciation covered the purchase price in the span of a single trading session. That's worth sitting with. A $60 billion acquisition, funded not by earnings, not by debt, not by the cash raised in the IPO itself, but by the market's belief in the stock. Moving fast enough to pay for the deal before the ink dried. When the currency you're using to buy things is your own valuation, the purchase and the belief that justifies it are no longer separate events. They're the same event, wearing two names. Zoom out and the scale becomes easier to feel. The $1 trillion the 5 largest hyperscalers are on pace to spend across 2025 and 2026 is comparable to the entire annual economic output of a mid-sized advanced economy, concentrated instead into server racks, cooling systems, and long-term power contracts, built on the assumption that a return will eventually show up to justify it. One financial analytics estimate places what that assumption actually costs at close to 94% of hyperscaler operating cash flow by 2027, nearly the entire income these companies generate from their existing businesses, reinvested before shareholders see a dollar of it. That's why the borrowing accelerated. When operating income alone can't cover the build-out, and the strongest quarter you can point to still relies on an unrealized investment gain, the next lever is debt, increasingly. Debt raised outside the parts of the financial system regulators watch most closely. The BIS pointed specifically at private credit and hedge funds now financing a meaningful share of AI infrastructure, channels with less transparency and less oversight than a conventional bank loan. But suppose every dollar of that spending gets repaid. There's still a second assumption buried underneath the financial one, and it lives inside the technology itself. Microsoft CEO Satya Nadella has said publicly that language models alone aren't enough, that the systems only become useful inside an ecosystem where humans still supply the judgment. That's not a warning against AI. It's a distinction the market keeps skipping past. A model that can generate an answer is not the same thing as a model that removes the cost of checking that answer. Every review step, every correction, every human sign-off is a cost the spreadsheet assumed would disappear and didn't. That gap between what a model can demonstrate on a benchmark and what a company can actually deploy without a person watching it is where a second, quieter risk lives, underneath the financial one. Inside the product itself. Here is the beneficiary and cost-bearer test, applied plainly. If the spending pays off, chipmakers collect on chip sales, cloud providers collect on committed capacity, and early investors realize gains that were priced in years ahead of the revenue. If it doesn't, the debt doesn't disappear. It sits with whoever bought the securitized paper, pension funds, insurers, annuity holders, several contractual layers removed from the decision to spend in the first place. None of this requires anyone to have broken a rule. That's precisely why the BIS chose the word opacity instead of the word fraud. A structure doesn't need to be illegal to be misread. It only needs to be complicated enough that the headline number, $1 trillion spending, record earnings, a stock that pays for its own acquisitions, stops being the whole picture. The technology itself doesn't have to fail for that gap to matter. Coding assistants and healthcare applications are already showing real, measurable value. That was never really the question. The question was always narrower: does the capital structure financing this build-out require the technology to outperform every previous general-purpose technology in history? On a timeline set by lease terms and debt covenants, while a growing share of this year's reported profit is coming from marking up a private stake rather than from selling anything at all. The risk was never really the chip, or the model, or even the company. It was the assumption wired underneath all three, that demand this circular could keep behaving like demand that showed up on its own, and that a paper gain could keep functioning like earned income. How much of that assumption is already sitting inside a fund you were told was diversified? Verify the exposure. Read the filing. Follow the mechanism. Nexnetia Global. Intelligence before the market moves. Nothing in this analysis constitutes financial advice.